Welcome to Module 12, Price. Today we're going to focus on pricing concepts. Let's look at the three questions. What is price? Why is price important? And how does price work in general, but how do you set a price on a product specifically? These are the questions that we'll address in this module. First, what is price? Price is all about capturing value. So if we say product is creating value, place relates to delivering value, promotion focuses on communicating value, price is about capturing value. Price is that which is given up in an exchange to acquire a good or service. Value is based upon perceived satisfaction. A reasonable price means perceived reasonable value at the time of the transaction. So why is price important? Why does price matter? Why do marketers care about price? Prices are the key to revenues, which in turn are the key to profits for an organization. An organization needs to focus on revenue. You can try to control costs, but revenue is key. Revenue is the price charged to customers multiplied by the number of units sold. Price times units equals revenue. And profit is revenue minus expenses. And price determines the revenues, as well as unit. Price and units equal revenue. Pricing objectives are also important. Need to be specific, achievable or attainable, and measurable. Categories of pricing objectives include profit-oriented, sales-oriented, and status quo. Let's look at each of those one by one. Profit-oriented pricing objectives. Profit maximization means setting prices so that the total revenue is as large as possible relative to the total cost. Satisfactory profits are profits that are satisfactory to the stockholders or investors in the firm and management. Return on investment, or ROI, is the net profit after taxes divided by total assets. This is the formula of ROI, net profits after taxes divided by total assets. Sales-oriented pricing objectives are based on market share as reported in dollar or unit sales. Market share is a company's product sales as a percentage of total sales for that industry. Sales maximization is when a company ignores the profit, the competition, and the marketing environment and just really focuses on sales and making sure that sales are rising. Two ways to measure market share. One is by units and one is by revenue. So if you look at company A, they've sold 1,000 units. That looks really good, certainly when you compare it to, let's say, company D. But they sold it at the unit price of $1, whereas company D sold 300 units at $4. So the total revenue for company D is actually $1,200 or $200 more than unit A's $1,000 total revenue. And you can look at market share from a unit market share. Well, company A has 50 units, whereas company D really only has 15. Or you can look at it from revenue market share. And from a revenue market share perspective, 25 units for company A, but 30 units for company D. In fact, company D is selling fewer units, but at a higher profit and generating more revenue. Status quo pricing is a pricing objective that maintains existing prices or meets the competition's prices. Generally, it leads to suboptimal pricing as it ignores customers' perceived value of the firm's goods or services and goods or services offered by the competitors. It ignores demand and costs. It is not generally a good model to follow. So how does price work in general? And then let's look at some particular strategies for a product. The nature of demand. Demand is the quantity of a product that will be sold in the market at various prices for a specified period. The lower the price, the higher demand for a product or service, and vice versa. When I say vice versa, I mean if the price is high, then that will suppress or lower the demand. Supply. Supply is the quantity of a product that will be offered to the market by a supplier or suppliers at various prices for a specified period. At higher prices, supply increases as manufacturers earn more capital and vice versa. Again, at lower prices, supply decreases as managers have less capital to work with. Elasticity of demand. Elasticity of demand is consumers' responsiveness or perhaps sensitivity to changes in price. If price go up a little bit, how many consumers continue to buy, or how many consumers stop buying? Elastic demand is a situation in which consumer demand is sensitive to changes in price. A small change could result in a lot of consumers from stop buying a product. Inelastic demand is a situation in which an increase or decrease in price will not significantly affect the demand for a product. So you can change the price and people still buy it, whether you raise it or lower it. Elasticity of demand. Factors that affect elasticity of demand include availability of substitute products and services, price relative to purchasing power of the consumer, the product durability, and a product's other uses. All these factor into how elastic or inelastic demand is. Dynamic pricing. Dynamic pricing is the ability to change prices very quickly, often in real time. It aids physical or brick and mortar retailers to compete more efficiently with online alternatives. When competitive pressures are high, a company must know when it should raise or lower prices to maximize its revenues. Dynamic pricing is also very common in businesses such as services-related businesses, where they have a very perishable product. So hotels, airlines often use dynamic pricing. The cost determinant of price. Sometimes companies minimize or ignore demand and price their products largely or solely on the basis of costs. Variable cost is cost that varies with changes in the level of output, but fixed costs are costs that does not change as output is increased or decreased. So those fixed costs need to be covered, and variable costs may vary depending upon how many you're producing. Markup pricing is the cost of buying the product from a producer plus amounts for profit and for expenses not otherwise accounted for. You're marking up the price. To use markup based on cost or selling price effectively, the marketing manager must calculate an adequate gross margin. That is, a margin must provide adequate funds to cover the selling expense and the profit. Markups are often based on experience. The book talked about a practice called keystoning, the practice of marking up prices by 100% or doubling the cost. That's very common in retail settings, like in clothing stores or retailers. Break-even analysis. Break-even analysis or break-even pricing is a method of determining what sales volume must be reached before total revenue equals total costs. It provides a quick estimate of how much the firm must sell to break even, how much profit can be earned if higher sales volume is obtained, but there are some limitations. It's hard to determine if a cost is fixed or variable sometimes, and it ignores demand. So break-even pricing is kind of a reference point, but not a great pricing strategy. Other pricing determinants include a variety of factors, and these factors besides demand and cost can influence price. A product stage stages in the product lifestyle. Is it early to the market? Has it just been introduced to the market? Is it in high growth stage or is it late and declining? That can influence the price. Competition can often influence the price. Sometimes competitors will price match. Also, customer loyalty. Are my customers very loyal or not so loyal? Do they shop around? Distribution strategy. Whether the product or service is sold directly to a customer or is there some type of intermediary that results in having the product being sold through another organization or individual. All those can affect the price. Internet's impact. Customers today are smarter, more savvier, more sophisticated. They do a lot of comparison pricing. Promotion strategy in general. Sometimes sales promotional tools can impact the price. A 2-for-1 sale might cut your profits in half, but it also may generate much more volume. Demands of large customers. Sometimes large customers have a lot of purchasing influence, and as a result, they demand a lower price because they're buying so much of your product or service. Relationship of price to quality. Is it lower or higher? How does it meet customer expectations? All these things are determinants of price. Impact of the internet and extranets have had an important influence on pricing. Internet auctions, often business-to-business auctions, may be the dominant form in the future. A shopping bot searches the web for the best prices for a particular item that one wishes to purchase. That gives pricing power to the consumer. Also, extranets, a private electronic network that links a company with its suppliers and customers, can provide a more seamless experience and add or reduce the overall prices. So how do you set a price on a product? Let's take a look at several steps. Basically, there are 4 steps in setting the right price on a product. You want to think about your goals, number 1. You want to also estimate your demand and cost and what profitability might look like, number 2. You choose a price strategy to help determine a base price, number 3, but then it's not perfect, so you have to fine-tune or adjust the base price with pricing tactics, and this hopefully leads to the setting of the right price and capturing the most value. Number 1, establish pricing goals. The first step in setting the right price is to establish pricing goals. A good understanding of the marketplace and of the consumer can sometimes tell a manager very quickly whether a goal is realistic or not. Trade-offs for each pricing objective that the managers must consider in light of the target customer, the marketing environment, and the company's overall objectives. Establishing pricing goals is the first activity. Number 2, try to get an estimate of demand and the costs and profits. Elasticity is a function of the perceived value to the buyer relative to the price. Is it perceived as high value or is it perceived as low value? The types of questions managers consider when conducting marketing research on demand and elasticity are key. After establishing pricing goals, managers should estimate total revenue at a variety of prices. Next, they should determine corresponding costs for each price and then estimate how much profit and market share can be earned at each possible price. Let's look at the third step. Number 3, choose a price strategy. A price strategy is a basic long-term pricing framework that establishes the initial price for a product and the intended direction for price movements over the product life cycle. The price strategy sets a competitive price in a specific market segment based on a well-defined positioning strategy. A company's freedom in pricing a new product and devising a price strategy depends on the market conditions and other elements of the marketing mix. For example, you might choose a price skimming strategy. A price skimming strategy is a pricing policy whereby a firm charges a high introductory price, often coupled with heavy promotion. Price skimming is successful when there's strong demand for a good or service. The product is legally well protected, represents a technological breakthrough or innovation, or has blocked the entry to competitors. Alternatively, you may consider a penetration pricing strategy, a pricing policy whereby a firm charges a relatively low price for a product when it is first rolled out as a way to reach the mass market. It requires a higher volume of sales to reach break-even point. Low prices can attract additional buyers to the market, and increased sales can justify production expansion or the adoption of new technologies. Status quo means charging a price identical to or very close to the competition's price. Simplicity is an advantage, but it's also a disadvantage that this strategy ignores demand or cost, or both. Typically, status quo pricing is not optimal pricing. There are other tactics that you can do to fine-tune your pricing. Other pricing tactics define neat categorization but may be used for various reasons. Single price tactic, a price tactic that offers all goods and services at the same price, or perhaps 2 or 3 prices. It's very simple and straightforward. Flexible pricing or variable pricing, a price tactic in which different customers pay different prices for essentially the same merchandise bought in equal quantities. There's also price lining. This is the practice of offering a product line with several items at specific price points. Leader pricing or loss leader pricing. This is a price tactic in which a product is sold near or even below cost in the hope that shoppers will buy other items once they are in the store. Bait pricing. Bait pricing is a price tactic that tries to get consumers into a store through false or misleading price advertising and then uses a high-pressure selling to persuade consumers to buy more expensive merchandising. This is unethical and often illegal. Off-even pricing, psychological pricing, a price tactic that uses odd-numbered prices to connote bargains and even-numbered prices to imply quality. For instance, the Hyakuyen store or something for $1.99 may signify cheap, or a high-priced product may signify expensive. This is called psychological pricing. Finally, 2 other types of pricing tactics might include price bundling. That's marketing 2 or more products in a single package for a special price. For example, do you want French fries and a soda with your hamburger? And 2-part pricing, a price tactic that charges 2 separate amounts to consume a single good or service. Okay, that pretty much wraps up our discussion of pricing. Let's do a quick review and preview. In this module, we looked at what is price, why is price important, and how does price work in general, but also how do you set a price on a product. For our preview, we will look at, for our next class, we'll meet on Teams for a briefing. We'll work in learning team channels, particularly on pricing, and then we'll have a short debrief and a break and the quiz, and then we'll meet on Teams again for the briefing. And I'll give you an opportunity to work a little bit on your draft presentation, and that will be in the second session. And then we'll debrief. But then I'll ask you to send me your draft presentation by Thursday. And in the following class, I'll walk through each group your draft presentation, and then you'll be able to refine it for your final presentation. Okay, that's what we have for now. Hope you're all well, stay healthy, and I look forward to seeing you in class soon.